In this lesson, we will learn how to price bonds conceptually. We're going to be not going into too much detail. As you know, this is part of the long-term liabilities lesson in our class. Just a little bit of background to begin with. So what motivates either the issuer trying to sell their bonds or the investor trying to invest their money in something useful? As you see here in this slide, you have a few different points and they sort of parallel each other on both sides. The issuer needs funding to expand or to just simply operate the business. They can either get funding from investors, so equity, or from creditors, meaning debt. So in terms of debt financing, we all realize that it's actually cheaper than to get the same amount of financing via equity. Financing is safer, so the risk reward concept will sort of naturally tell you that it should be less of a return on that to the investor than equity would be. Equity is there's more risk in that, generally speaking. So that's the reason sometimes debt is better than using stock issues to finance operations. Next point is that the bonds themselves are one instrument in debt financing. And just to keep things straight, we should remember that bonds have certain terms. They have a face value, which is the same as a principal for notes, a contract rate, and some kind of maturity date from which we can determine what's the term. It could be 1 year, 3 years, 5 years, and so on. From an accounting perspective, the issuer is looking or is going to be recognizing some kind of interest expense over time. From the investor side, is they have normally obviously excess cash that they want to invest outside of business. Given their risk tolerance, they will choose from competing investment options. The risk profile they're looking for will determine the required return desired. This is what we basically refer to as the market. The market will determine the rate, and so that's the investor goes out and see what kind of options they have in terms of investing and getting a return. Now the return is always a result of a calculation based on the cash flows that come from that investment. Normally, normally it's cash, and normally in the case of bonds, that is interest. And so we'll talk about that mostly from the issuer's perspective, but is the same thing applies to the investor on the other side of the same transaction. And from the accounting perspective, the return from the debt investment, or the bond in this case, is actually, as I said before, interest revenue. Now, there are obviously some standard journal entries we'll be talking about. They sort of parallel each other on both sides. So the issuer and the investor, for the most part, will be just focusing on the issuer in this lesson. So there's the bond issue itself and the recognition of the interest expense. That comes from two parts. It comes from the interest payment or the accrual, and also in the case where there's a discount or a premium, it also comes from the amortization of that discount and premium. And we'll talk more about that in a second. And finally, the third transaction for bonds would be the recall or the retirement of the bond at the end of the term. From the investor side, the issue on the issuer side is actually the investment on the investor side. Instead of recognizing interest expense, they'll be recognizing the interest revenue, and then they obviously give back or the bonds back to the issuer at the end, or they simply sell them to somebody else. Now the actual JEs are as follows, and again, I'm not going to worry about the investor side at the moment in this lesson. The bond issue, there will be a credit in all cases regardless of the scenario that we'll be talking about. There's a credit to the bonds payable account, that's a liability account for the face amount. There's a proceeds entry, meaning the cash received from the investor. And then depending on whether there's a discount or premium, there will be a debit to a discount on bonds payable account or a credit to a premium on bonds payable account. And we'll show you how that's determined in a bit. There's also the interest expense. You're gonna, if you're the issuer, you're gonna book debit to an interest expense account, and then you're gonna either accrue it or you're gonna actually pay the cash. And then again, in terms of the interest expense, the premium and discount is amortized each period. A certain fraction of the discount or premium that was booked initially back here is going to be brought down to either to interest expense. So either it's going to actually reduce interest expense, or it is going to increase it. We'll talk more about that in a second. And finally, the recall. We have the reduction of the bonds payable account to eliminate it. There's a related premium that's already there, or discount that hasn't, any unamortized portion of that bond payable that is being eliminated should also be eliminated. So between these two, you have what we call the carrying value. So you're going to be getting rid of the carrying value. Then you figure out what is the cash that the issuer is paying to get back the bonds. And then finally, the difference between the carrying value amounts and the cash paid, that will determine the gain or the loss on that transaction. Now let's talk a little bit about mechanics. Well, not really mechanics, conceptual mechanics, I guess I would call them. So here on this slide, we're going to start talking about the pricing process of the bonds. And again, this is actually the issuer's perspective. And in this case, we're answering this question: what is the timing related to the bonds? So I wanted to show you how a bond typically is set up. The investor and the issuer are right here doing basically negotiating and saying, how much do I need to pay you for these bonds? Well, if depending on the pricing process, you're going to have a proceeds amount that is less or more than the face amount. And so regardless of the actual proceeds, the mechanics is that you're going to take the cash flows from the bond. You're going to look forward and see what the cash flows are going to be from the bond. And normally, again, it comes in the form of interest payments. In this one here, we have 10 periods. Again, I'm using a generic timeline here, and I'm assuming 10 periods. And this could be 6 months, okay, this could be years, doesn't matter. But there are actually 10 separate interest payments in the life of this bond. So that's a series of cash flows that will go to the investor from the issuer. Then the face itself is also returned to the investor at the end of the life of the bond. And so in this case, there's actually 10 cash flows from the interest payments, and then one for the return of the face. And so the timing is always that way. You always have a cash flow related to the interest payments every period, and then you also have a return of the face at the end. This next slide is the follow-on part of the process. But in this case, we need some numbers to kind of show you how this works. So here is the sample problem 1. That's what I'm calling it, just to give you a reference label. And so in this case, I'm using the same kind of information from bonds that I'm using as an example in a different lesson. So you can just follow the same thing here. The issuer has a bond of $100,000, 12% rate. This is a contract rate, a 5-year term, meaning that if you have semi-annual payments, meaning that you have 2 payments per year, that means that there's actually 10 payments in this case. or 10 periods, I mean. In terms of the actual amount of interest expense each period, you take the face times the contract rate times the period. In this case, it's half a year. So the amount of interest paid every 6 months will be $6,000. So then I will then lay out the cash flows on the timeline like this, and that takes care of the interest payments of cash flows. And then at the end, I also have that return of the face to the investor. So when you do a bond pricing problem, this is what I would recommend. You first look at the timing, and then you look at the actual cash flows and put them on that timeline. And now let's talk about the last step. What determines the price itself? Well, there's a calculation that we're going to be using, and it's based on this. Pricing is computed by doing the or applying the present value to the cash flows themselves, and this is done at the market rate. So at the moment here, we don't have a market rate yet, but we would just apply whatever the market rate happens to be to the series of cash flows, and then also to the single amount here. And we will be using different types of tables or formulas. This will be this series, we call it an annuity, uses the present value factors for an annuity. This one here, since it's only one single cash flow, we will use the present value factor table or formula of $1, meaning a single cash flow. In a separate lesson, we will talk about the actual mechanics of that. Here, you're going to get a good gist for it, but it's not the time to talk about details. So if we take that concept, again, of present value here, and apply them to these cash flows, then we're going to be able to get what the price is. The proceeds are going to be actually paid by the investor at the beginning of the issue, at the time of the issue. To do that, or to apply the process to a specific example, I'm going to be using what I call a simplified problem. And it's very simplified because we're only assuming a single period. At 10%, it's a $1,000 bond, and the term is 1 year, annual. So this is just in one single payment. So as you can see, if this comes from, I just made up this name. This is actually Betty Inc. So she is trying to issue a bond at a time when the bonds. Well, I guess we'll talk about the market rate in a second. But at the moment, just determine the cash flows and the timing. So again, we only have one period, and there's only one interest payments, because if I do the $1,000 here at 10%, 1 year, the interest is exactly $100. So that's what that is. So that's the cash flow from the interest payment. In this case, this is not a series, simply just as one single amount, which is fine. And then you also have the return of the face to the investor, and then that will determine, once we apply the present value calculation, that will determine the proceeds that then is paid by the investor. So let's move on to first case. The first case, because we have three cases, we can issue at face, issue at a discount, and also issue at a premium. And so we're going to talk about the issue at face first, using the very same bond that we just talked about, Betty's bond. She's the issuer, and Ivan is the investor. Now the investor, based on his, tolerance for risk and return, he determines that he wants a 10% return as well. Betty's bonds are exactly that 10%, so there's no need to do anything to the actual pricing. We know the pricing will be the same as face, so we don't really have to even do this calculation. We know already that when the CR or contract rate is the same as the market rate, that means the price will be the same as face, and so we're set in this case. When it comes to premiums, the setup is the same, except for that Ivan is actually only requiring 8% because competing investment options required about 8% as well. But Betty wouldn't be happy with that. She would be giving way too much on that. So then, in that case, she wants to adjust her interest payment. I'm sorry, not interest, but the return on these bonds down to 8% from the 10%. Now, the amount that the bond will provide the investor through the interest payment is still $100. It's still 10%. So they cannot do anything about the actual terms of the bond. But you could actually adjust. By the way, one more point. So the cash flows are the same. The cash flow is still the $100 to the interest to the investor through the interest payment, and the return of the $1,000 to the investor. So that is the same thing as previously. And in this case, when you apply the pricing calculation based on the present value, using the market rate actually in this case, you're going to end up with proceeds of 1,019. So notice in this case, the pricing is higher, the proceeds are higher than the face. That's a premium. The additional $19 will prove to be the way you actually adjust, or the way that Betty will adjust the effective return or the effective yield to Ivan. And again, it will be another piece, another part of this lesson where we go through the mechanics of that to show you how that works. That's issuing at a premium. And then there's the scenario of issuing a bond at a discount. Same discussion here as before. The bonds are still at 10%, but now in this case, Ivan, the investor, needs or requires 12%. So the investor may not be attracted to Betty's bonds because he can get 12% someplace else. But Betty says, I don't worry, I can actually adjust my bond through the pricing to effectively give you the 12% you want. And so let's look at the cash flows again. See here, $100 is the interest payment, still $1,000 is the return to the investor. So that doesn't change. The same thing is the cash flows are the same because the terms of the bonds are the same. They're fixed. They cannot change. So that's fine. This actually amount really represents a 10% return, but the investor wants 12%. So to make up for it, they're going to actually only have to pay $982. If we apply the market rate using the present value calculation to these cash flows, that gives us the $982. And that differential of $18 is really an additional interest expense to the issuer because they only are borrowing $982, yet they're giving back to the investor the full $1,000. So differential becomes more interest expense for the issuer, and on the other side, it becomes more interest revenue to the investor. So their yield on these bonds goes from 10% up to 12%. And so here is my sort of rendition of the three scenarios we just talked about. So we got Betty, who's going to issue some bonds to Ivan. And no matter what the market rate happens to be, Ivan will also always make whatever required return he demands. Here is the bond. Again, in each case, in each scenario, the bond is the same. And in the case of Ivan, the investor, at face means that the required return he wants is the same as the bond. So it's 10%. For the discount scenario, it is 12%, and for the premium scenario, it's 8%. We already saw that. And here again, the cash flows in sort of visual form. And so again, the investor gets the cash flows from the interest payments and the face amount at the end, and then they're going to actually provide some kind of proceeds based on that calculation that we just talked about. Same applies to the discount scenario, and then the premium scenario is the same thing. Notice that again, this cash flows are the same. The only difference will be what the proceeds based on the present value calculation. And here's the result. If you do the math, you will, again, in the case of the face, the interest payment is $100. The amount given through the proceeds is 1,000 based on the present value calculation. And so if you take $100 divided by the $1,000 investment, the return is 10%. We happens to match the required return needed by Ivan. So then that is fine. And then let's move on to the discount. In that case, the $100 is the same as we said before, and there's a discount of $18. And so to the issuer, to Becky, to Betty, that 18 represents additional interest expense she has to incur because of discounting. And in terms of Ivan, actually, he gets the $100 plus he gets an additional 18 through the discount. So when you divide 118 by the total of 982 investment, that's how you come up with the 12%. So 10% comes through the interest payments, and 2% comes through the discount. On the premium scenario, again, $100 is the initial interest payment to the investor, and then the premium paid by the investor initially, that reduces the interest expense to Betty, but it also reduces the return to Ivan. So the net return to Ivan is only $81. If you divide that by the 1019 proceeds, that gives you the 8%. That is what he requires in this scenario. Notice again that the $100 is the 10% that comes from the bond interest payments, and the $19 represents a 2% reduction to match then the contract rate to the market rate. Now, if you want more detail for each of these three scenarios, the last three slides at the very bottom of this presentation gives you more detail on this. I'm just going to show you a couple more slides. Goes back to the sample problem number one. If you go back to the given information for that bond, this will be the entry that we will make if the market rate was the same as the bond. Remember that the bond there in that situation, it was contract rate of 12%. So if the market rate happens to be the same, then we are issuing at face. Oops, that's face. So that's the entry that you would see there. Debit cash for 100 and credit bonds payable for 100,000. No premium, no discounting. For the premium scenario, if you go back to that given, again, 12% is a contract rate that doesn't change, and the market rate is in that case 11%. So we're going to ask the investor to give a premium of $37.69. The bond payable is still $100,000, and we book a credit to a premium on bond payable account, which has a credit normal balance of $37.69, which we're going to amortize over time. And then on the discount situation, we've got again, CR is still 12%. This is actually it's like this, right? Like that. And then this one will be like this. So contract rate is 12%, and the market rate in this scenario is actually 13%. If you go to the calculation, then you actually end up with credit of 100,000 to bonds payable. Here's the cash proceeds of 96,406, and here's a booking to a discount on bonds payable. That's a debit of 35.94, which is also again amortized over time into the income statement as additional interest expense. Now, last thing I'll show you this. Now, how do we know that this is exactly the amount we need to create this discount to then convert these 12% bonds to 30% bonds? So I'm going to show you the calculation. It looks like this. I use an Excel spreadsheet, set up all the periods, like I said before, figure the payment from the interest payments right there, all those 10 in that case. At the end, there's also a return of the actual phase, and then I use the half a year rate of the market rate. So the market rate is 13%. The half year is 6.5% each period, And if I do the present value factors, either formula or tables, I know that that's actually the correct present value factor for that period. Here's the present value factor for 9 periods at 6.5%. Here's the one for 8 periods. Oops, am I in the right place? Here, it's 8 periods, also at 6.5%, and so on. When you do those multiplications, here and here, here and here, you end up with these present values. Then you add up all of these together to get to that pricing there. If you have any questions, use the website, our course site. Enjoy.